Good morning to each and every one of us. We are now going to present the company profile, company analysis, and industry analysis of Jollibee Foods Corporation, Wendy's, and McDonald's Corporation. First is the company profile. Jollibee is a multinational chain of fast food restaurants with roots in the Philippines, run by Jollibee Foods Corporation. Jollibee is the largest fast food chain in the Philippines and one of the fastest growing restaurant companies in the world. It is also on rank 13 among fast food chains in the world. In fact, it has set out its mission to overtake the top 5 restaurant chains globally but went down to 13th place during the pandemic. Notwithstanding, JFC is still committed to accomplishing that objective. JFC had 1,500 Jollibee locations globally as of December 2021, including eateries in Southeast Asia, the Middle East, East Asia, North America, and Europe. In addition to that, JFC also owns other fast food brands in the Philippines, such as Chowking, Greenwich Pizza, Red Ribbon Bake Shop, Manginasal, and Burger King Philippines. Since 1979, JFC has been accepting franchise applications, and franchises currently run more than 1,000 Jollibee outlets. As a dominant market leader in the Philippines, Jollibee enjoys the lion's share of the local market, which is more than all the other multinational fast food brands in the country combined. During the 2021 financial year, the revenue of Jollibee Foods Corporation in the Philippines was valued at approximately 154 billion Philippine pesos. Jollibee was founded by Tony Tan Caktiong and his family in 1975 at Pasig, Philippines, with its humble beginnings as an ice cream parlor which later grew into an emerging global brand. Today, Jollibee has grown from a single brand to a restaurant group with 18 recognizable names and more than 6,200 locations in 34 countries and with overall 10,959 employees. The key to its success is a family-oriented approach to personnel management, which has earned Jollibee recognition as one of the most admired employers in the region. It has received awards from the Personnel Management Association of the Philippines as Employer of the Year, Hewitt Associated as Best Employer in the Philippines, and the Asian Wall Street Journal as one of the top 20 employers in Asia. By concentrating on the distinct tastes of the Filipino market, which were different from those of the American Fast Food Corporation, it was able to endure the debut of the McDonald's in the Philippines in 1981. In Taiwan, the first Jollibee store outside of the Philippines opened in 1986, which is now closed. Both domestically and internationally, Jollibee continued to expand and open new locations. Jollibee serves great tasting, high quality, and affordable food products, including its superior tasting Chicken Joy, mouth-watering Yum Burger, and deliciously satisfying Jolly Spaghetti, among other delicious products. With a strict adherence to the highest standards of food quality, service, and cleanliness. Other than that, JFC also offers property leasing, manufacturing, digital printing, advertising, financial accounting, human resources and logistics, business management, and other services.
Wendy's is an American international fast food restaurant chain founded by Dave Thomas on November 15, 1969 in Columbus, Ohio. Its present headquarters are in Dublin, Ohio in the United States. With 6,358 locations worldwide, Wendy's is the third largest burger chain. As of 2018, its annual sales were over $1 billion. Burgers and fries are two of Wendy's most recognizable trademarks. A squared patty and fresh meat are used to make burgers. Based on the appearance of Thomas' daughter, who also provided the idea for the company's name, Wendy's cartoon depiction of a happy red-headed child became one of the fast food's most recognizable trademarks. The Wendy's Company, the world's third largest quick-service restaurant company, operates through Wendy's Restaurant Limited Liability Company, its subsidiary holding company. Through a subsidiary, the fast food corporation runs the Wendy's restaurant network as a franchisor. Its Canadian business was combined with its international sector as a result of some significant managerial and operational changes, and its real estate and development operations were divided into their own segment. In its current organizational structure, the firm is divided into the three following segments, namely Wendy's United States, Wendy's International, and Global Real Estate and Development. Sales at restaurants owned and operated by the corporation and franchise-related earnings, such as royalties, donations to the National Advertising Fund, rentals, and franchise fees, are its two main revenue sources. Dave Thomas Pickup Window, the first drive-thru in the contemporary era, was created by Wendy's. This innovation was so revolutionary that customers needed instructions on how to talk through the speaker to place an order. Originally called the drive-in window, Dave wanted to change the name from something that could attract cruisers and joyriders. Additionally, Wendy's kept spending money on its well-received homemade advertising with Dave Thomas. Despite being well known for its memorable advertising campaigns, Wendy's only spent $80 million on advertising in 1994, about half of what McDonald's did. Even yet, Wendy's brand awareness lagged McDonald's by just a few points. The operations at Wendy's location are seasonal, with summer sales being higher than the winter sales. With these changes, the results of any future quarter will not be indicative of the results of another quarter of the whole fiscal year. During Thomas Dave's existence, Wendy's chain saw a considerable increase in the number of patrons dining there. The company's market share decreased from 14.5% to 13.6% shortly after his death in 2002. McDonald's, Burger King, and other cutting-edge chains like Five Guys and Fry's presented it with intense competition.
For our third company, McDonald's. McDonald's is a limited-service fast food chain with more than 35,000 locations throughout more than 100 nations. It is the world's largest fast food service and supplier. More than 4 million people work here every day and serves 70 million people. In 2014, IBIS World estimates that McDonald's held a 17% market share in the US for fast food restaurants. The brothers Maurice and Richard McDonald founded the first McDonald's restaurant in San Bernardino, California in 1940. It is used to be a drive-in with a large assortment of goods. But later on, the brothers decided to restructure the company in 1948. They created the Speedy Service System, which is a straightforward and effective ordering system. They restricted the menu to just hamburgers, potato chips, drinks, and pie. And due to the enormous success of McDonald's, the brothers started a franchise system. Since opening its initial restaurants, McDonald's has expanded at an impressive rate because of an internal concept known as expand at all costs. At the peak of 5 business expansions, a new McDonald's store opened every 5 hours. The management instilled the idea that as more restaurant locations are opened, the more customers will be served, and this leads to higher profits that would be realized across the company. With this, McDonald's expanded their menu and now primarily sells our favorite comfort foods like the hamburgers, various varieties of chicken, chicken sandwiches, French fries, soft beverages, breakfast dishes, and desserts. The company has always utilized major principles throughout its history to expand rapidly, increase sales, and remain market leader. By leveraging their enormous cash flow, brand power, real estate, and customer spending habits, McDonald's has not only emerged as the worldwide leader, but also revolutionized our eating habits. McDonald's success drew greater criticisms, much of which focused on its perceived relationship with a global increase in obesity, wherein numerous lawsuits were brought against the corporation. In response to the criticism, McDonald's expanded its healthy menu and started creating vegan hamburgers, which were marketed under the names McVegan, PLT, and McPlant. Despite the criticisms, McDonald's standard of marketing, advertising, and promotion make them infinitely profitable as an enterprise. With a revenue of $23.223 billion in 2021, McDonald's success today is largely attributed to its franchising model, consistency, and innovation. Through their franchising model, they were able to enjoy rapid growth.
Moving on with our industry analysis, we prepared a SWOT analysis of Jollibee, McDonald's, and Wendy's. The SWOT analysis has a relevance with the cash flow because the SWOT analysis is employed in the valuation and strategic planning of the organization. The strengths and opportunities produce returns, which convert into enhanced cash flow predictions. Strengths and opportunities can minimize risk by increasing price multiples or lowering the cost of capital. Threats and vulnerabilities have the opposite impact. A SWOT analysis begins by highlighting internal strengths and weaknesses that have an impact on corporate success. These competitive advantages or core capabilities that produce value or money, such as a strong sales team or great quality, are examples of strengths. Weaknesses, on the other hand, are characteristics that restrict a company performance. These are frequently exposed when compared to rivals. As seen in the table, Jollibee Food Corporation, which was founded in the Philippines, is not as well known in other countries as McDonald's and Wendy's, and thus they should focus on marketing and capitalizing on brand loyalty, which is one of their strengths when considering their expansion plans in other countries where Filipinos are present. Generally, the strengths and weaknesses of a business relate directly to customers' needs and expectations. Each identified characteristics affect cash flows and therefore business success. The following SWOT stage is to identify opportunities and strengths. Opportunities are favorable external conditions, and the most important opportunity that the three companies are attempting to focus on is the high demand for drive-thrus and deliveries, because during the peak of the pandemic, travel restrictions are imposed and there is a high demand for Grab deliveries or Foodpanda, so it would generate a worthwhile return if the business acts on it. Threats, on the other hand, are external factors that could impede business performance, and the problem of unhealthy foods, different tastes and preferences of other countries in terms of food has been a common threat for all quick-serving restaurants, and Jollibee, McDonald's, and Wendy's are not exempted. So, they must try to solve the issue by incorporating some foods with nutritional value into their menu in order to not threaten the sale of their companies. Next, we have here the report about the major players of fast food industry dominating the Philippine market. Due to the increased preference for online food delivery since COVID-19 restricted many activities, consumers' preference for convenient, on-the-go food options has increased and has become another significant market driving factor. Quick-serving restaurants or fast food chains currently account for the majority of the market share in the Philippines. The strongest player among the top 5 fast food chains in the Philippines has historically been Jollibee Food Corporation, which benefits from a loyal customer base. McDonald's is the second strongest player, but Wendy's was unable to crack the top 5 due to its inferior location density in comparison to its rivals. We also have here the chart for the market share in the global market. And as previously said, one of Jollibee Food Corporation's weaknesses is that it is not well known enough abroad. which serves as evidence that it has a smaller worldwide market share than Wendy's and McDonald's. But this doesn't mean that it has no chance of dominating the global market, since Jollibee is still in the growing stage of the industry. According to the article, Jollibee Food Corporation opened its first franchise in 1980, making a sale of 24 million pesos. After 20 years, Jollibee Food Corporation continued to dominate the hamburger industry, reaching a market share of 57% compared to McDonald's market share of 36%. This shows that it still has a lot of potential, and on the other hand, McDonald's and Wendy's have been around since 1940s and 1960s respectively, and have experienced multiple life cycle stages. The two businesses are in revival stage, which occurs between the maturity and decline stages, and is characterized by rapid development through innovation and large risk-taking due to the ongoing rise in competition.
For the industry analysis, we also have the 5 competitive forces model of Michael Porter for Jollibee Foods Corporation, McDonald's, and Wendy's. As shown in the table, there is a strong competitive rivalry among the business because of the oversaturation of the market and low switching costs that made it simple for the customers or consumers to switch from one restaurant to another. The bargaining power of suppliers of the 3 companies is on the weaker side because of the large number of suppliers relative to buyers. This means that in the restaurant industry, the suppliers are dependent of the buyers and the substitutes are available. While bargaining power of suppliers is very weak for the 3 companies, bargaining power of customers or consumers for Jollibee, McDonald's, and Wendy's is very strong. This is because the products are not differentiated and there is low switching cost for the buyers in this industry. The buyers can go from one supplier to another easily and depend less on a particular supplier. Next is the threat of substitute products, which is strong for the 3 companies since again, there is a low switching cost for the buyers and that the substitute products have equal to better attributes or performance compared to the actual products. Lastly is the threat of new entrants. For Jollibee, McDonald's, and Wendy's, the threat of new entrants is in moderate force because the capital cost in establishing a new restaurant business only partially limits the entry of new business in the market.
The table shows the 2021 cash flow annual analysis of the 3 corporations: Jollibee Foods Corporation, McDonald's Corporation, and the Wendy's Company. Jollibee Foods Corporation is operating in a highly competitive industry, and developing sustainable competitive advantage is one of their challenges. Looking at the company's cash flow analysis, there is a roller coaster of results regarding the company's operations and financial management. With an operating cash flow ratio of less than 1, which is 0.43, Jollibee has not generated enough cash from operations to cover its current liabilities. Similarly, the 14% cash flow from operations over the average total liabilities indicates that it can retire only 14% of its total debts using its cash flow from operations. For investors, this low ratio could mean that the company needs more capital. However, this does not reflect that Jollibee is experiencing poor financial health. In contrast, Jollibee has a current ratio of 1.43, which means if there is not enough cash flow from operations, there are other financial resources for them to remain solvent in the short term. This ratio coincides with their 12-day receivables collection period under the cash conversion cycle, which reflects that their customers pay on time and their receivables are rarely written off. In addition, with the 1.22 quick ratio, the company also has no problem getting rid of their current liabilities. These are good signs to both investors and creditors. From an investment perspective, a smaller price to cash flow is preferred, and this is favorable to Jollibee with a ratio of 0.20, as this somehow reveals ample cash flows that are not yet considered in the current share price. However, the cash flow margin ratio does not reveal much of a very good result because it is only 13%, but comparing it to 2020 ratio of negative 0.3%, which is the impact of pandemic, the company has indeed made a great step from this unfavorable ratio, and in 2019 where they had only 11% ratio. In this company analysis, Jollibee's cash conversion cycle is a desirable situation. The negative 0.39 shows that their inventory is being sold before they even pay for it. Their vendors are practically financing their business. Their working capital is literally working and they have a greater liquidity. As one of the largest multinational fast food chains, Jollibee Foods Corporation has surely built a name as a company, as the firm confirms plan to expand in Europe by growing to 50 stores in the next 5 years, and with its recovery from the pandemic, this fast food giant is a great investment. To note, the company already plans to issue around 8 billion pesos in preferred stocks and buy back $250 million of perpetual bonds this year to strengthen their statement of financial position and spread the maturity of their debts. McDonald's Corporation is known as the largest fast food service after having been expanded at an enormous rate in the market. The company's operating cash flow ratio is favorable with 2.17 because this indicates that they are generating more cash in a period than what is needed to pay off its current liabilities. Comparing it to the 2020 ratio of 1.01, McDo did a great job in this area because in operating cash flow ratio, the higher the number, the better shape the company is. This is the same theory when it comes to current ratio. The higher the current ratio, the more capable a company is of paying its obligations. The current ratio of 1.78 and similarly quick ratio of 1.76 reflects that they have a larger proportion of their short-term assets as compared to their short-term liabilities. They can easily settle their debts using their current assets. It is also making a good stand in its 154% cash flow from operations over average total liabilities. They could pay almost half of their liabilities using only cash from their operations. The downfall for this analysis is their price to cash flow ratio, because theory states that a good price to cash flow ratio should be anything below 10, and McDo has a 20.11 ratio, which means that the company is overvalued with respect to its cash flows. They may have a good standing in settling debts, but they are facing a challenge on cash flow margin with only 39.36% because they may not be efficiently making sales into cash and they have high expenses, but it is still a desirable result as compared to last year's 32.62%. Currently, their cash conversion cycle is somewhat unfavorable with 87 days of their working capital being tied up while waiting for their accounts receivable to be paid. For a large company, this may not be a good result as it takes a long time for their inventory to be paid and the time for their customers to replenish their cash flows. For a long time of doing business, McDo is surely an established company. At present, McDonald's is facing crippling inflation. Their sales are strong but their earnings eroded down 28% to $1.1 billion as much of their food they sell has been hit by inflation. For investments, it may not be the time to consider McDonald's. The Wendy's company is one of the largest quick service restaurant companies and it is following other food giants' footsteps. Looking at how the company stands on their cash flow analysis, some areas are desirable and some are not. Their operating cash flow ratio of 0.81 indicates that they are not having enough cash to pay their current liabilities, and this could mean to investors their need for additional capital. However, they may use other assets, not just their operational cash flow, in settling their debts because of their 1.39 current ratio and 1.37 quick ratio. This means that they have financial resources to remain solvent in the short term. However, theory states that the current ratio between 1.5 and 3 is considered healthy and the company still has not reached this range. Their quick ratio reflects that they instantly settle their current liabilities, illustrating that they have $1.37 liquid assets to cover $1 of their current liabilities. Another downfall is their operational cash flow over average total liabilities. The ratio of 8% shows that they are not generating sufficient cash flow and they do not have the liquidity to meet their debt obligations. They also have a low cash flow margin with only 0.18%, indicating that they are not efficiently making sales into cash. For investors, Wendy's may not be the stock that they want to own, but if we look at other ratios, the company is still favorable. The price of their stock is a good result with only 0.01 ratio, and they are generating ample cash flows that are not yet added in the current share price. As for their cash conversion cycle, the 34 days it takes them to convert funds invested in production and sales to cash is favorable. They are fast in converting their initial capital investment into cash. As the analysis shows ups and downs, Wendy's may find it challenging to grow and maintain a competitive position in a highly dominated industry. Currently, the company is one of the large companies who are making surprising results in trading, as their largest shareholder is exploring a potential deal that includes acquisition or merger, which seeks to enhance the shareholder value. This may be a turning point for investors.